Good morning, everyone. Welcome to our presentation. Today, we're going to explore the fascinating topic of internal versus external liquidity. I'm excited to guide you through this subject, which is crucial for understanding market dynamics. On this first slide, you'll see the title and the presenter information. Over the course of this session, we'll cover key concepts, differences, and their implications in the market. So let's get started and dive into the world of liquidity. Now, let's take a closer look at liquidity and smart money concepts. In this context, liquidity is essentially about understanding where the market has potential to move, and that often revolves around key areas like stop losses, pending orders, and zones with high retail participation. These elements are crucial because they help us identify where the smart money, or the big players, are likely to target or move through. Stop losses, for example, are often placed just beyond support or resistance levels, and recognizing these points can give us insight into where the market might hunt for liquidity. Pending orders, like buy or sell stops set by traders, also create zones where liquidity can build up, making them potential areas for significant market moves. And then there are areas with high retail participation. These are zones where many traders are active, often resulting in increased liquidity that the big players can tap into to fuel their moves. Understanding these components is vital because in fluctuating markets, being aware of where liquidity is concentrated allows us to better anticipate market behavior and craft more effective trading strategies. It ties directly into the overall theme of smart money concepts, getting inside the minds of the big players and understanding their mechanics to improve our trading edge. Let's talk about external liquidity. This refers to the liquidity pools that exist outside the current price range we're observing. Essentially, these are the buy-side liquidity above the recent highs and the sell-side liquidity below the lows. Understanding this external liquidity is crucial because it plays a significant role in how prices move and how we develop our strategies. When we look beyond the current price, we're seeing the larger pools of orders that can influence future price action. Recognizing where this liquidity is located helps us anticipate potential reversals or breakouts. So, in summary, external liquidity is about the liquidity outside what's immediately visible, and it's a key element in understanding the overall market dynamics and making informed decisions. When the market forms equal highs, what's happening is that buy stops tend to accumulate just above those levels. These are orders placed by traders who are waiting to buy once the price reaches a certain point. As the price pushes upward and expands, it's actually taking in this buy-side liquidity. This process shows how external liquidity, meaning liquidity from outside the immediate market, can drive significant market expansion movements. This example really highlights the importance of understanding liquidity flows. When we see these equal highs, it's a sign that a lot of buy orders are stacked just above, ready to be triggered. And as the market moves higher, it's essentially consuming that liquidity, which fuels further movement. Connecting this to our overall theme, recognizing how external liquidity influences market expansion helps us better anticipate potential breakouts or reversals. It's a key piece of the puzzle in understanding market dynamics and making more informed trading decisions. Let's dive into the concept of internal liquidity. Internal liquidity refers to the amount of liquidity that's actually available within the current price range we're observing. This isn't about the entire market, but specifically what's happening within the range where price is currently moving. Key elements that make up this internal liquidity include fair value gaps, which are areas where there's a lack of trading activity, and order blocks, which are zones where institutions tend to place their large orders. We also look at minor highs and lows within the range, as these points can influence how price reacts and where liquidity pools might form. Understanding this internal liquidity is crucial because it helps us anticipate potential support and resistance levels, and it guides us in understanding the trade dynamics at play. By recognizing where liquidity is concentrated within the range, we can better position ourselves to capitalize on potential price movements. So, in essence, internal liquidity is about the liquidity that's already present, ready to be tapped into as prices move within that range, making it a vital concept for effective trading within ranges. Now, let's talk about internal liquidity and why it becomes so critical once external liquidity has been fully exhausted. Essentially, external liquidity, those big institutional funds coming into the market, can run out or dry up, leaving the market more dependent on the internal liquidity within it. This internal liquidity is often found in the form of orders, stop losses, and other resting orders that are already in the system. When the market starts to retrace or pull back, this internal liquidity plays a key role. Price often retraces into what we call fair value gaps. These are areas where the market previously moved swiftly through, leaving a sort of imbalance. These gaps act as magnets, drawing price back in, and this retracement provides institutions a chance to rebalance their positions. It's like a pause for reflection, a moment to adjust before the next big move. So, understanding how internal liquidity works during these retracements helps us anticipate potential support levels or reversal points, which is essential for positioning ourselves advantageously in the overall market flow. Let's take a moment to understand how both types of liquidity are crucial for price delivery. External liquidity is what enables impulsive, rapid moves in the market, often happening when large pools of liquidity above or below recent price levels are targeted. This is what drives those sharp, expanding phases we see on charts. On the other hand, internal liquidity provides the necessary pauses or retracements within the trading range. These are the moments when the price pulls back to fill order blocks or fair value gaps, giving market participants a chance to reassess their positions before the trend continues. Understanding these expansion and retracement phases helps us see the bigger picture of market dynamics. External liquidity fuels the explosive moves, while internal liquidity offers the space for reflection and preparation. Both are essential for the overall flow of price and for making informed trading decisions. Now let's take a closer look at this cycle and understand how trends develop in the market. Essentially, external liquidity sweeps generate momentum, which then leads to significant price movements. This process encourages ongoing market participation as traders respond to these shifts. After the initial expansion phase, we often see a pullback into internal liquidity. This is a critical moment because it allows institutions to rebalance their positions before the next big move driven by external liquidity. This pullback isn't just a pause, it's a strategic moment for smart money to prepare for the next expansion. Speaking of smart money, they frequently initiate aggressive price expansions to secure external liquidity. By doing so, they drive the market towards specific targets, influencing price action in their favor. These aggressive moves are not random. They are carefully targeted strategies to deliver prices to key levels and further extend the trend. All of these elements, trend development, pullbacks, and aggressive expansions, are interconnected. They form a cycle that helps explain how markets move and why certain price patterns emerge. Understanding this cycle is crucial for anticipating future market behavior and making more informed trading decisions. Let's dive into why establishing higher lows or lower highs within internal liquidity zones is so important. When we see these patterns, it actually indicates strength in the current trend. This behavior suggests that the market might continue in the same direction, which gives traders valuable entry opportunities for their strategies. Recognizing these setups can really help in timing your trades better. Next, we have the concept of filling fair value gaps. Think of these gaps as areas where the price has moved quickly and left a void. Filling these gaps is essential because it helps restore price efficiency. Internal liquidity plays a key role here, ensuring that the price moves back to these gaps smoothly. This process keeps the market balanced and prevents erratic price swings, making transitions more seamless. Now, let's talk about mitigating order blocks. Order blocks are zones where significant buying or selling occurred, and they act as potential reversal points. Internal liquidity helps mitigate these zones by allowing the price to react appropriately, respecting existing supply and demand levels. This reaction can signal potential reversals, which are crucial for traders looking to identify turning points in the market. Overall, understanding how internal liquidity influences market structure, from establishing trend strength to filling gaps and mitigating order blocks, is fundamental. It helps us see the bigger picture and enhances our ability to anticipate market moves with confidence. In this example, we see that sell-side external liquidity is taken, which causes a change of character, or CHoCH, to the upside. This shift indicates a potential reversal or momentum change in the market. Following that, the price retraces into a bullish fair value gap, or FVG, suggesting a temporary imbalance where supply and demand are out of sync. This retracement into the FVG creates a strategic entry point for buyers. Essentially, we're looking for these signs: liquidity being absorbed and price pulling back into a FVG, as clues that the market may continue upward. This process highlights how understanding liquidity and FVGs can help us identify strong bullish setups, especially in instruments like XAUUSD. It's all about reading these subtle cues to align our trades with the overall bullish bias. So, to wrap things up with insights, let's talk about understanding liquidity in trading. Liquidity is essentially how easily an asset can be bought or sold in the market without causing a significant price change. High liquidity means you can enter or exit trades smoothly, which reduces risk and transaction costs. It's a key factor because it affects how efficiently markets operate and how traders make decisions. If liquidity is low, it can lead to more volatile prices and make trading more challenging. Throughout this presentation, we've seen how liquidity impacts everything from market stability to the strategies traders use. Understanding liquidity helps you become a more informed trader, allowing you to assess when the market is favorable and when caution is needed. So, keep these insights in mind as you continue to develop your trading approach, because mastering liquidity is really about mastering the ability to navigate markets confidently and effectively.